Okay, right. So, here we are. So typically, I've talked about the sorts of things that we can see within the equity section. Other components of equity um, typically will include the revaluation surpluses, any movements, and we will come to see when we talk about financial instruments, investment reserves. I might have used the analogy, I believe, of, well, because we're currently looking at consolidation, aren't we, in class? And I sort of highlight the point that it is possible. I create a spectrum, if you remember, that from going from having a subsidiary where you own, say, whatever, 70% of the share, so this is you owning a subsidiary, to you owning an associate where you have significant influence. So I'll say you own 25%, to you just owning 5 to 10%. These are all assets and these are all investments, but the standards guide us as to how we prepare them in relation to ourselves, if you like. There's very clear guidance. So here we consolidate and we create the idea of single entity for faithful representation. Here we just have the investment and we just add on our profits as we go along. So these two kind of merit the whole idea of stability. They're there. We add on profits of the subsidiaries, so to speak, as we're going along. The issue is here. And the issue, of course, I'll use two scenarios. You have listed companies and you have non-listed. So simple trading companies, so to speak. So imagine you had 5 to 10%. If you have 5 to 10% of a listed company, these are shares that are volatile, constantly changing. And there has to be some thinking has to go into. We have to think a little about, well, what happens if there's constant change in the fair value of these assets? I mean, we have IFRS 13. We'll come to see that to guide us as to how we look at how we treat this. So you've bought this thing, debit investment, credit bank. This thing's changing in value. So because they are volatile, then chances are you're holding them because you wish to buy and sell them. You're doing a bit of trading on the side. I don't know. But the key point is they're listed. You're never really going to control a listed company from 5% unless that's the plan. So generally you'll have movement, and those movements are generally recognized in the income statement, and that those changes are happening. And that seems the most fair way to recognize those movements, right? But it is possible that you might own 5 to 10% in a small business, say, for example, on the outskirts or whatever, small trading company. So the intention is not to sell them, you intend to hold them. But at the end of the year, you value them because we have standards that require that you value these things on a year-to-year basis. And if it's increased in fair value, because you're still holding them, the argument is that to recognize them, they're not trading, to recognize them within the income statement in of itself is slightly it's not faithful representation. It's best to hold them within some sort of reserve. And that's what's sort of happening here. And that's what we're going to be exploring when we look at Chapter 9, that sort of spectrum of recognition of these assets, so to speak. Okay. Typically, the statement of changes in equity, if you remember, it just shows us what are the movements in the equity section. We'll see the statement in a second. So typically, it's very possible to have some new ordinary shares being issued. We'll see ordinary shares. We will see movements in share premium, and of course we will see the movement in retained earnings and other reserves, if you like. So really, we just want to see clearly what are those movements, and we create you almost have a separate statement. And this is your classic kind of look. I mean, sometimes you see another reserve like general reserve. An organization might want to move some retained earnings into that general reserve for the future and sort of say that we don't want to touch this. But generally, this is your layout of this. So you're really sort of looking at what happened at the beginning of the year and comparing it to what's happened at the end of the year. And that's your statement of changes in equity. Changes, of course. What are the changes over the period? And dividends should be somewhere where you see dividends going out, and dividends are always paid out of retained earnings. Again, you have an issue of share capital, of course. We might have some share premium attached to it, and then you have some comprehensive income affecting this as well. And like I was saying, well, total comprehensive income. So this is everything. So realized profit for the year plus other comprehensive income. You might have prepared two separate statements, irrelevant. The key point is that we're aware that there's this thing here called other comprehensive income. So this is income and expenses that are not recognized in profit or loss. Again, like I said, they are recorded in reserves, if you like, via the other comprehensive income sort of area. Yes, because and again, this might just be profit that's not yet realized. We've made some money. It could be on forex, for example. So if you remember that we have a standard, we'll come to see that a standard that tells us that when you buy, say for example, you borrowed some money, or you bought some inventory or whatever it is, and from a foreign company, and you owe them, and you have a current liability, for example, what you have to do is at the year end you have to reevaluate this amount at the closing rate. So you might have bought it at, I don't know, $1 to £1, and at the closing rate you have to assess again the closing rate of the exchange's closing rate to assess the liability. And if it's moved against you, for example, if you now have to convert more of your currency to pay them, you now need to recognize that loss. So those movements, it could have been a gain, if you like, are recognized, if you like, in this area. Okay, great stuff. So again, like I said here, for the purposes of FR, other comprehensive income include changes in the revaluation. Well, oh yes, for us, of course, and lots of things could be happening, but our focus will primarily be what will affect us in our syllabus would be when we have revaluation of non-current assets, if you like, and of course these financial assets I talked about earlier on. Those are the movements we will see, if you like, through. Those are the two main things we will get tested on: revaluation of non-current assets and those movements in the financial assets, like I talked about our spectrum over there. So typically those financial assets between the 5 to 10%. Our issue won't be with associates and full subsidiaries or greater than 50% subsidiaries, because we have a different standard as to how we deal with those. So typically here we have consolidation, which we are currently looking at, and here we have another type of way of adding things, but it's just literally recognize the investment and add on the profit, your share of profit, as we go along. So here we are talking a little bit about not-for-profit organizations and public sector organizations. Different aims to us. Profitability is not really their aim. This is more about a discussion. You're not going to be prepping any sort of public sector accounts or anything along those lines, because for us, primarily, right, we are all about profit. That's what our most profit organizations are trying to do, and to add value to their shareholders. So typically IAS 1, if you remember, IAS 1 is a big IAS. It has lots in there, but it does tell us pretty much what statements they would like us to prepare: statement of profit or loss, and other comprehensive income. Again, like I mentioned that. But for your not-for-profit sectors, the aim really is, if you like, how do you add value to your stakeholders? So typically they have, government subsidies, and that's sort of their funding, government funding, and the managers are, so whatever, local government, NHS, that sort of thing. It's really providing a public service. I mentioned earlier on, we will come to see that in greater depth, about these fundamental qualitative characteristics of what's referred to as the conceptual framework, or the framework, or the underpinning of prepping financial statements. And typically the two ones are relevance and faithful representation. And relevance here, accounting standards are designed to measure performance accurately and consistently. That's what we're really trying to go for here. And that's kind of what's going on here with relevance. We're trying to make everything as useful, if you like, for the user. Yes, this is again talking about not-for-profit public sectors. We're not going to be prepping anything, but I think they're just trying to make us aware of what's going on, what's happening here. Right, so for the public sector, it's very much just making sure things are in line with inventory, non-current assets. We're not really interested in revenue recognition. There's no earnings per share, but it's really just an understanding of what's taking place. Right, I just want to take you very quickly to so this is what the statement of profit or loss and other comprehensive income looks like. Nothing new here. Your revenue, cost of sales, gross profit, and you have your key sort of grouped expenses. So distribution costs and admin expenses. I don't think it really matters. I've seen some structures of SAD, selling and distribution, admin, and then distribution. You'll be told, follow the exam question carefully as to where to classify things in. Then you have profit from operations, and then you have finance costs, any investment income, profit before tax, income, tax expense, and profit for the year. And then you have other comprehensive income, like what I was saying here, gain or loss on revaluation, gain or loss on fair value through other comprehensive, whatever income, financial assets, and then you have total comprehensive income. So I think what's critical is remembering that you will be looking primarily at revaluation and then fair value movements on those financial assets post that, right? I think that's the main thing I wanted you to pick up on that. All right, great stuff. So that's the end of chapter 1. Now, what I need you to do is, after going through this, because this is chapter 1, I'm sure that this is a revision of the past, really. So you want to sit down and you want to definitely go through the TYU here and actually prep it to see if you remember how to actually prepare a statement of profit or loss and a statement of financial position for yourself, again, as good revision to see if you're comfortable with the layout. So it's important to do that example and to do the TYU as well, to do both, if you like, and kind of confirm to me that you have done that and that you're happy with that. Cool, great stuff. So that's the end of chapter 1, and then please do the TYUs and the examples relating to this in your text. Cool, great stuff. Thank you.